The Federal Reserve signals that it's prepared to raise interest rates by 0.5 percentage point multiple times throughout the year to combat inflation, which has a lot of investors concerned that we are going to be sliding into a recession. But that's not what the Fed says. The Fed says that they think they can raise interest rates at a rate that can combat inflation without throwing us into an economic downturn or recession. So why don't investors have confidence that the Fed can do this? Well, the main reason is the yield curve and the flattening and now inverting of that curve. Now, you might not know what the yield curve is. I definitely didn't in my 20s, but the yield curve can be a foreshadowing of what's to come. So that's what we're going to go over today so that you guys know how to use this tool to prepare for the future. And we're going to try to do it in a way that is very easy to understand. Before we go into this video, please help us beat this YouTube algorithm. Just hit the like button. Let's get this video out there. Let's make impact on other people's lives. First off, the yield curve is a measure of all of the treasury bonds that they're selling over a period of time. It's a benchmark that predicts economic output and growth. The most frequently reported yield curve compares the 3-month, 2-year, 5-year, 10-year, and 30-year US Treasury debt. If you want to see these curves, they're on the Treasury's interest rate websites and they're updated every trading day. So a healthy yield curve or a normal yield curve will give you a lower return for a short-term or a shorter-term investment and a higher return for a longer-term investment. So they're incentivizing long-term commitment. For example, if a 2-year bond offers a 1% yield, a 5-year bond would offer a 1.8% yield, a 10-year bond would offer a 2.5% yield, and a 20-year bond would offer a 3.5% yield. So looking at the graph, when these points are connected, we have the shape of a normal yield curve. Now there's two groups that control the yield curve. One is the Fed, which controls the left side or the short-term side of the graph, and they can reduce rates, which reduces borrowing and reduces money supply, or they can drop rates, which incentivizes borrowing. What we're seeing right now is that the Fed is adjusting rates up. And what they're communicating is that they are going to temporarily put interest rates above the expecting resting level. Now, the Fed indicated that they could raise Fed funds rate to about 1.9% at the end of this year, about 2.8% at the end of 2023, and then land somewhere around 2.4% after that. The right side, or the long-term side, is controlled by investors. In a strong economy, you'll see investors move dollars outside of long-term bonds and into riskier investments like stocks. Because the demand is going down, you're seeing a price reduction in bonds, but bonds and price have an inverse relationship with yield. So as bond prices go down, yield goes up. Therefore, long-term bonds have higher returns than short-term bonds in a normal yield curve. And that's why a normal yield curve implies stable economic conditions and a normal economic cycle. Now, the opposite happens when investors start to become concerned with the economy. Then you start seeing them take money out of riskier investments like stocks and put them into bonds. Now, when more dollars are going into bonds, remember, that brings demand up, which brings price up, and because of the inverse relationship, that brings yield down. Now, you typically start seeing this after a big economic boom period, which leads to inflation and then concern of an economic slowdown, which is basically what you're seeing, or the concerns of what you're hearing coming from the Fed with raising interest rates. Then what we started seeing was the yield curve starting to flatten and then ultimately invert. When you start seeing the flattening of the yield curve, you see very little difference in yield to maturity from shorter and longer term bonds. For example, a 2-year bond could offer a 5% yield, 5-year offer 5.1%, 10-year offer 5%, and a 20-year offer 5.05%. Now, moving into an inverted yield curve, which is probably pretty explanatory at this point, that's when the short-term bonds produce a higher yield than long-term bonds. Now, this yield curve going inverted is actually more rare, but we officially saw that happen yesterday. And an inverted yield curve is a very high indicator that we're heading into a recession. It's like, I think 11 out of the last 12 recessions were followed by an inverted yield curve. And this is why the concern from investors is starting. Ganeet Dhingra, who is head of US interest rate strategy for Morgan Stanley, is saying that he doesn't think we're going to see the usual doom and gloom from an inverted yield curve. Now, this guy is a lot smarter than me. I'm looking at a lot of people agreeing with him, but I'm also looking at a lot of people saying we are absolutely heading into a recession. No one really knows at the end of the day, but what we do know, eventually we will move into a recession. This is part of the market. We will go through cycles. We will always go through them. The good thing for us to plan for is that we will be heading into one at some point. And we want to be in a position to participate in the opportunity. So make sure you're able to buy when certain investments are on discount, and also are sticking to your buy-sell strategy when the market's up, that you're selling when it's up. And that allows us to constantly hover through this kind of middle zone of making money over the long term. That's what puts us in a pretty good spot. But what I want to know from our audience, do you think we're heading into a recession? Do you think that this yield curve will show that coming, or do you have a different opinion? Leave it in the comments. Let us know if this video helped, and we'll see you guys next week.